Valens Research, Uniform Financial Analytics.
For AMD, what we're seeing that's so interesting is, again, it's around the question of asset growth, right? For AMD, when you look at as reported asset growth for the company, you would see a company that grew massively the last 2 years. It grew over 30% a year the last 2 years. You'd say, this is great. This is a company that is really, as it is transforming its business, right? Returns in the last 2 years have been basically 8% is what you're looking on an as reported basis. You say, great. Returns have finally inflected. This company is gaining scale. It's strategizing the right way, and it's able to grow into this new business. That's exactly what I want to see as an investor. And you'd say, yeah, of course, I'm going to pay a 46 times multiple for a company that's transforming its business. What we see once we look through uniform accounting noise is, yes, returns have inflected positive. They've, by the way, been positive only 1, 2, 3, 4, 5 other times in the last 15 years, which is important to note. So AMD has historically not been a company that's been able to sustain long-term positive profitability, which is a warning sign. But they've done that not by growing massively. They've done that by monetizing their current asset base. And that calls into question these white bars, right? If you've got a company that's never been able to generate a above cost of capital return, they've had an above cost capital return 2 of the past 13 years before 2018, 2019. You've got a company that has that kind of history. Even if they've got exposure to AI, they've got exposure to cryptocurrencies and everything else, it does raise the question of, is this trend sustainable? Because what the market's pricing in for this company at a 46 times multiple is for continued growth and for ROA to expand massively, right? The average semiconductor firm, just for context, and let's just look really quick right here. What I can do is we can actually look at what is the average return of semiconductors. Now you can see right now, there are a lot of semiconductors that actually have pretty good returns, right? This is actually really, really impressive, quite frankly. But what we're pricing in for AMD right now is for AMD's returns to get to 36 by 2024 and stay there. Just for context, let's look. How many companies have a better than 36% return right now? You've got MSCPH and Texas Instruments, right? And Texas Instruments, by the way, has done that, expanded their returns by basically turning themselves from a semiconductor firm into something that's a really more unique manufacturing firm and divesting a lot of their assets. They've shrunk to generate that return. And yet we're pricing AMD to basically be up here with only 2 other semiconductor firms and do it sustainably. Once we realize they're not growing to do this, and that means that they don't have all these opportunities that people may think, well, that calls into question whether or not that's reasonable. And so what we can do is we can pull open the embedded expectations tool here, and we can do a quick scenario analysis. Let's understand, do we really, what would the company be worth if we had a more pessimistic view on the company? Like, let's say we said, hey, you know what, AMD, realistically, we're going to give it the benefit of the doubt and say, under new management, under Lou, who's been there since I think around 2016 or so, or 2015, we're actually going to think that they are now a cost of capital or better business, but they're not going to massively sustain returns at these all-time high levels every single year going forward. If we think that this is the scenario for AMD right here, we're got a company that's worth 80% less than it is right now. Let's be more beneficial. Let's say, hey, you know what, AMD, the average semiconductor right now probably has about a 20% ROA, right? If I just look at this clump in the US, let's type in 20. They had a 20% ROA, which, by the way, would still be above any return that they've ever generated historically, right? What we're doing here is not pricing in that they're going to have a collapse in profitability. We're pricing a company that's only had 2 years in the last 10 where returns were above cost of capital to have returns be 4 times cost of capital in perpetuity going forward. That's an incredibly bullish expectation. Even pricing that in, this company is worth 45% less than it's at right now. Like, this is not a cheap company. This is not a company where market expectations are low, which is important to remember.
Valens Research, the world's leading source for uniform financial analytics.